Adding a partner to your business can be transformative, but it requires careful planning and execution. Some of the world's most successful companies started as partnerships. Microsoft with Bill Gates and Paul Allen, Disney with Roy and Walt, and Ben & Jerry's with Ben Cohen and Jerry Greenfield. These partnerships grew into multinational corporations through shared vision and complementary skills. When partnerships work well, they function like a well-played orchestra. When they don't, the results can be disastrous. The challenge is that it's difficult to predict how a partnership will unfold until it's actually operating. Before bringing on a new partner, thorough due diligence is essential. Assess the potential partner's financial stability and their ability to contribute capital. Ensure your business goals are aligned and that you share a common vision for the future. Evaluate how their skills and expertise complement your existing team. Consider legal and regulatory compliance requirements and discuss risk management strategies, including liability exposure. The process for adding a partner varies depending on your business structure. For corporations, the process is more formal. You'll need to review corporate bylaws to determine if adding a partner is permitted and what steps are required. Obtain board and shareholder approval as necessary. Decide whether the new partner will receive newly issued shares or buy existing shares. Update corporate documents including articles of incorporation and shareholder agreements. File any required legal paperwork with state authorities or the IRS. Finally, clearly define roles and responsibilities in an updated agreement. For LLCs, converting from a single member to a multi-member structure involves filing tax forms associated with operating a partnership and amending the operating agreement. This agreement should address the amount of capital the new partner is investing, their compensation, and their role and responsibilities. Typically, you don't need to report new members to the government until your annual report is due. For sole proprietorships, the process is simpler, but still requires filing for a federal employee identification number, since you can no longer use your Social Security number with multiple owners. Partnerships offer several advantages. They allow business owners to leverage the efforts, expertise, and skills of more than one person. Risk is allocated across multiple owners. Partners provide support and a stimulating social environment. There's minimal government control over partnerships, and expenses are shared among all partners. However, partnerships also have disadvantages. Disagreements between partners are inevitable. All partners are legally responsible for the actions of other partners, including borrowing money and hiring employees. When partnerships dissolve, the process can be messy, similar to a divorce. To protect all parties involved, proper legal agreements are essential. These include a partnership agreement outlining ownership structure, financial obligations, and dispute resolution processes. For LLCs, an operating agreement details management roles and dissolution terms. Corporations need shareholder agreements governing stock issuance and transfers. Non-compete and confidentiality agreements protect business interests, while buy-sell agreements specify terms for partner exits. Adding a partner affects your business's financial structure. The new partner may need to contribute capital in exchange for ownership. Profit-sharing percentages must be clearly outlined. New partners may assume a share of business debts. Tax considerations change, affecting reporting, deductions, and liabilities. Working with an accountant or tax professional is highly recommended to understand these financial implications. When reporting business earnings and losses, partnerships use Form 1065, U.S. Return of Partnership Income, and file individual K-1 forms to reflect each partner's portion. While a partnership agreement isn't legally required, it provides valuable guidelines for operations, dispute resolution, and eventual dissolution. There are two classes of partners: general partners who make decisions and maintain liability, and limited partners who primarily raise capital and retain limited liability. All partners pay taxes on their allocated share of profits. A key difference between partnerships and LLCs is liability protection. In partnerships, each partner is personally liable for all debts and the actions of other partners. LLCs provide limited liability, meaning members are only liable to the extent of their personal investment. When transitioning operations with a new partner, clear communication is essential. Inform employees about the new partner's role and responsibilities. Align operational strategies with new partnership goals. Notify clients and vendors of any leadership changes. Update banking authorizations and financial access as needed. Adding a partner to your business is a significant step that can bring new resources, expertise, and growth opportunities. With proper planning, due diligence, and legal documentation, you can create a partnership that strengthens your business and sets it up for long-term success.